Thank you all for joining the webinar this afternoon. My name is Malcolm Pengelly, and I'll be your host for the next hour or so. So, what are we going to cover? We've got the usual hot topics and news items. That's being covered by Jeff Webber and Rob Edwards. Our substantive session this time around is basis period reform, what you need to know and what you need to do in this transitional year that we're now in. We've got, that's with Jitendra Patel. Spring budget 2023, a little more in-depth on the changes to pensions legislation. Chris is going to run that one. And Sadiq is going to cover off the impact of corporation tax increasing to 25% and what you can do to help your clients reduce the impact of that. And always at the end, there's a mop-up Q&A. So can I have the next slide, please? So here are our usual suspects, most of whom I think you will probably recognise. As I said, our special guest speaker is Jitendra Patel, who is a principal in our partnership tax team and has been leading the firm's submissions to HMRC on partnership tax reform. He's also the vice chair of the CIOT's Owner Managed Business Technical Subcommittee. I think a few of you may have come across him during your time on the tax line. He's dealt with a number of partnership type queries over the years for us. Next slide, please. So without further ado, I'm going to hand you over to Jeff and Rob.
Good afternoon, everyone. This is Jeff Webber. I'm one of the tax line consultants, and I'm just going to give you a brief heads up on a couple of selected news topics. So can we have the next slide, please? The two topics I'm covering are HMRC's new approach to associate dentists and their employment or self-employment status, and a very quick run through of ongoing SDLT cases before the tribunals, which seem to be coming through almost every week at the moment. Let's start on the first bullet about HMRC's new approach to associate dentists. For many years, there's been an informal agreement between the British Dental Association and the Dental Practitioners Association and HMRC that associate dentists can be treated as self-employed, this being based on a standard form of agreement for associate dentists. These relate to dentists practicing as an associate in another dentist practice. And where these agreements were in place and the terms followed, the associate dentist would normally be accessible to tax as self-employed, and this avoided arguments about employment status with HMRC. However, for reasons best known to themselves and without any consultation, from the 6th of this month, that's 6 April 2023, HMRC has formally withdrawn this guidance from the employment income manual, and the effect will be that the employment or self-employment status of each associate dentist will be based on the usual case law for deciding whether someone's employed or self-employed, and HMRC also recommend using their digital CES employment status tool to establish employment status. Although most people do not have a great deal of faith in the CES tool, I've got to say. If HMRC in any particular case decides to challenge the classification of the associate dentist, and on the basis that they believe them to be employed and not self-employed, then of course the employer dental practice will be on the line as the deemed employer. And if an HMRC challenge is successful, the dental practice will then become liable for income tax and NIC payments for their associate dentists. So obviously great care will be needed in cases where you have dentists amongst your clientele, either as associate dentists or as principal dentists who are using these associates. We don't know what the outcome will be. Many accountants specializing in dentists have opined that it won't make a great deal of difference, but we think that existing agreements should be reviewed. Care should be taken. There's nothing in them which indicates that status is more akin to employment. There isn't any case law on associate dentists. The only case law that we're aware of is not tax, but it concerns employment legislation, and where there are three types of situations. A person could be self-employed, an employee, or a worker under employment legislation. And I think in many of these cases, worker status has been decided. Unfortunately, there is no such status in tax. It's a cliff edge. They're either employed or self-employed. So the case law is only of very limited use. And I think great care is needed in each case. And I suspect that many principal dentists may be thinking about insisting that their associate dentists operate through personal service company in order to shift the risk to them under IR 35. But time will tell. The guidance is new, and we just don't know how it's going to work out at the moment. There's been very little about this in the standard tax technical press, so I just wanted to give you a heads up about it. The next topic I'm covering very briefly is the ongoing legislation, or sorry, not legislation, the ongoing litigation before the tax tribunals on whether properties are residential or mixed use for SDLT purposes. At present, if a property is purely residential, it could be liable to SDLT depending on the purchase price on up to rates up to 15%, and if you're non-resident, it rates up to 17%. Whereas non-residential mixed properties are only liable to SDLT at a maximum of 5%. So there's obviously a huge incentive to try and show a property is mixed rather than purely residential. There have been a number of cases recently. They seem to be coming through each week at the moment. One thing I should mention, and it's worth noting, is in all these cases, the original SDLT filed by the conveyancing solicitor showed the property as residential, and SDLT was paid at residential rates. Subsequently, a specialist SDLT repayment outfit came along, had a look at this, and suggested that that there should be an amended SDLT return filed, claiming that the property was actually mixed use. And in many of these cases, HMRC just went along and made the repayment and then subsequently challenged it. Certainly, the use of an SDLT repayment agent and the subsequent filing of an amended SDLT return seems to set the alarm bells ringing as far as HMRC is concerned. So our advice would be, if your client is approached by one of these repayment agents, great care should be taken. We're always happy to give an opinion on whether there is or isn't a realistic case. I'll just mention a few of these cases. The first one was James Fayers v. HMRC, where the individual claimed that the presence of an electricity pylon or pole and cables on his land via an easement granted to the electricity company was enough to make that part of the land non-residential, and therefore the entire land and house mixed. This was dismissed by the tax tribunal. Another one, rather than mixed use, was the case of Mudan v. HMRC, where it was claimed that a house that was bought in very poor condition, not quite derelict, but in a very poor state, was unsafe to occupy and therefore was not suitable for use as a single dwelling, invoking the Bewley case of a couple of years ago, where a completely derelict house was accepted by the tribunal as not suitable for use as a dwelling. In this case, the tribunal would have none of it, and they said it was in poor nick, but it needed a bit of refurbishment and was therefore suitable for use. Third case I'm going to mention is the case of James and Charlotte Avadiak v. HMRC, which again was a mixed-use case, and it turned on the meaning of grounds of a dwelling. They claimed, or rather their repayment agent encouraged them to claim, that because there was part of a busy public road within the boundary of their residential property that served no functional purpose other than being a road, this was enough to make the dwelling mixed. This was rejected by the first tier tribunal. And the last case I'm going to mention is Danielle and Sexton, the HMRC, where two sisters purchased long lease of a flat in central London, a very expensive one, which came with an easement allowing the use of a communal garden in the square, which the block of flats surrounded. The argument was that because they didn't have exclusive use of it, it couldn't be residential. Unfortunately, this was also dismissed by the tribunal. So there have been very few cases where an appeal of this sort has succeeded. Generally, you need to show that the land is in commercial or other use to have much of a chance of succeeding in this sort of argument. That's all for my heads up. I'm going to pass you on now to my colleague Rob, who will give you a heads up on VAT. So next slide, please.
Well, good afternoon, everybody. I hope you can all hear me. My name's Rob, and I think some of you know me, looking down the participants list. And I'm one of the VAT consultants on the tax line. So just three things I just want to bring to your attention this month. And firstly, HMRC have revised their export guidance for VAT, and in particular in relation to the evidence required. So you may remember that you are required to zero rate goods. One of the requirements is that you have to prove that the goods have left the UK. So you either have the official evidence, which is if you're still using the old chief system, will be the goods deposit message, or on the new CDS system, it's a cleared export entry, or in the MSS data, it's a status of entry with code 8, or you have commercial transport evidence, and it's commercial transport evidence that most traders will have. And this includes things like authenticated way bills, authenticated C-way bills, or international consignment notes, which have been completed fully by the vendor, by the consignee, and by the haulier. Now, what HMRC's guidance has been changed to say is now that basically if the commercial evidence is not up to scratch, so there's things missing, so that, like there's a vague description of the goods or the values are wrong, then they will require a trader to produce the official evidence, which is slightly, it's a departure from what they used to do, which is where they give you time to actually produce the commercial evidence. HMRC are also suggesting that if the commercial evidence is wrong, that you may also be faced with a customs penalty or customs duty penalty as well. So official evidence should be available because the freight, at least the freight forwarder, if not being done by the trader themselves, should be able to get hold of the cleared export entry. You can't actually put the goods onto the ship, onto the plane, until you've got that on CDS. Now, we also expected HMRC to increase their compliance activity in this area. 2 years, now 2 years since Brexit, and now that we're seeing a ramp up on certainly customs duty inspections, VAT inspections as well, looking at this area. So it's something to be aware of, that where maybe in previous times traders will have got away with a zero rating, HMRC will be looking very hard at the evidence that traders have when they are zero rating goods outside being sent outside the UK. Second one is a recent first tier tribunal case, which is Universal Flooring. And this was a case to do with a dishonest conduct relating to evasion penalty, which is quite rare, or certainly used to be quite rare for HMRC to issue that. And this relates to where basically someone in the company, their direct acts have led to tax evasion. And it's not just acts, it's also omissions to act as well. So in this case, just to give you a brief rundown, the There were uncertainty VAT returns, and the company was issued with what they call the central assessments. That's the automatic assessments by HMRC, guessing how much VAT was due. And these were all less than the correct VAT liability. Now, HMRC tried to argue that the director did not point out that the central assessments were wrong, and that this was deliberate. This is a deliberate act by the director to pay less VAT. Now, this is the second case of this type in as many weeks. And in both cases, the trader taxpayer has won. And in this case, that the first tier tribunal basically said that HMRC failed to show that the director knew that the assessments are wrong. Apparently, he was a bit of a workaholic and didn't really question anything in the accounts or the VAT returns, including the fact that he overpaid £36,000 on a previous VAT return without realising it. Now, the main reason for flagging this case is that HMRC go for this with your clients. Do not be afraid to challenge it, because HMRC seem to be bringing out the big guns where they wouldn't have done before. They seem to be bringing them out now to try and essentially get more money out of taxpayers. The other thing it highlights as well is that it is important to make sure that your clients understand the VAT returns, the figures, and how the numbers have come to those, how you come to those numbers on the VAT returns when they are presented to the clients. And the last one is happy birthday VAT. As Malcolm's already said, VAT reached 50 years old on the 1st of April this year. Those of you old enough to remember it coming in, I'm not, it was 11 years before I was born. Anthony Barber, the then Chancellor, said, "This VAT is a simple tax." You know, I'll let you decide that for yourself. But just some interesting facts about VAT. It's the third highest earner for HMRC behind income tax and national insurance contributions. 175 countries now in the world now operate a VAT or GST system. You may remember such highlights of VAT that's determined Jaffa cakes were cakes. It determined that Pringles are crisps, even though at the time of the case in the late 90s, they were only made of 42% potato. And more recently, Tunnocks tea cakes are also cakes and therefore also zero rated. But really, just a reminder that really BDO has specialists in all areas of VAT. So therefore, we can, if not necessarily myself, Marvin or Chris, the backline consultants can assist directly. We can certainly point you in the right direction as somebody if you have any sort of particular specialist VAT queries. That's it from me. Back to Malcolm on the next slide.
I'll even remember to unmute myself. That would be quite good. Thank you, Jeff, and thank you, Rob. We have no questions on the hot topics round, so perhaps we can have the next slide, please, and do continue to post questions as and when we will answer them. But for this session, let's go over to Jitendra Patel. He's going to talk us through basis period reform and what you need to know in this transitional year. Jitendra, over to you.
Good afternoon to everyone. So I'm Jitendra Patel, as Malcolm mentioned earlier. I'm a principal in BDO's tax group here. I specialise in advising professional services businesses, and I also lead partnership taxation for BDO. I've been involved in assisting Malcolm and his team with the tax line for about 7 or 8 years. So hopefully I've come across many of you before and had some excellent conversations over that time. So today I'm going to be talking to you about basis period reform. I'm going to cover some background to the changes, what it means in practice, and what businesses need to consider now. It's a relatively short slot, so I'm going to be rattling through fairly quickly, but there'll hopefully be a couple of minutes at the end for some Q&A. But if we don't have time for that, I'm obviously happy to answer any questions you have after the webinar as well, either through questions you post today or through follow-up calls to the tax line. Next slide, please. Okay, so just to give you a bit of background, I'm sure you all know these rules already, but I wanted to provide a bit of context and just cover the present system for basis periods as it stands until we have basis period reform. So sole traders and members of trading partnerships currently tax on the profits arising in their basis period for the tax year. Now, usually the basis period will be the same as the business accounting year, ending in the tax year. And historically, many businesses, partnership businesses in particular, have used 30th of April year end. So for example, the last accounting date ending 30th of April 22 falls within the 22-23 tax year. We've had special rules from when individuals commence trading or join a partnership, known as the opening year rules, and when the business ceases or a partner leaves the partnership, what we call the closing year rules. And these rules mean that some profits are taxed twice in the opening years, giving rise to what we call overlap profits. And then relief for those overlap profits is received generally under the closing year rules when a partner leaves the partnership or the business ceases, which means that generally speaking, all profits are only taxed once, but we do have these complications in the early years. Next slide, please. So why reform basis periods? So what did HMRC tell us when they announced these reforms? They said this would make transition to making tax digital for income tax easier. And if we remember that making tax digital was due to start from April 24, but it's since been delayed to April 26. They also said it was to simplify tax admin for the self-employed and partnerships. Now, for many, that might be true. However, for many large partnerships that don't have a tax year accounting date, they will argue potentially the opposite. Actually adds a lot of complexity to their administrative procedures. What HMRC told us was definitely not the case was to accelerate tax payable on profits. But I've listed that there with a question mark because we suspect that the government likely saw the amount of tax acceleration that was likely to arise as a result of this, and we're rubbing their hands in glee with those extra tax receipts coming in very handy. When does reform take effect? So 23-24 is a transitional year. And in case anyone's forgotten, that's this year. And then we move into 24-25 next tax year for the full year of the new system. Just a quick point on making tax digital on there. So I mentioned that this has been delayed for income tax until April 26. I think it's still very unclear, particularly for partnership businesses, when making tax digital will come in and what it will look like. So how that's going to work at that point is still very unclear. We've been talking to HMRC, but they're not giving a lot of information away at the moment. Okay, so what's changing with basis period reform? So we're going to be moving from the current basis into this new tax year basis. So that means that profits that arise in the tax year will be taxed. And that means where you've got accounting periods that are not coterminous with the tax year, then apportionments of profits from those consecutive accounting periods are going to be needed. For many businesses, then this means that profits are going to be taxed sooner. And also it means that estimates may be required where taxable profits for an accounting period are not determined when the returns are due. Just a point to note there that businesses can treat 31st of March as equivalent to 5th of April. So that means that daily apportionment is not required. So if they do have a 30th of March year end, then they're already effectively on a tax year basis. Or if they choose to move to the 31st of March year end, that will be the same result. Next slide, please. Okay, so we're going to look a bit more closely at the transitional year and what's happening. So as I mentioned, I keep mentioning 23-24, so this year is the transitional year. And what's going to happen effectively for this year is that the profits under the current year basis period are going to be brought into tax, and then there's going to be an adjustment to bring the remaining months of 23-24 into tax as well. So that means that if you haven't already got a 31st of March year end or 5th of April year end, then you're going to have more than 1 year of profit being brought into tax. So, for example, 30th of April 23 year end, you're going to have your 12 months to 30th of April 23 plus another 11 months to the 31st of March 24, giving 23 months of profit in total taxed in this period. There is a full deduction given for any overlap relief brought forward, so that does give some relief, but traditionally and based on our experience, often the overlap will be smaller than these additional profits being taxed as a result of this transition. Usually to do with whether the increasing profitability of the business or in a partnership, for example, where new partners tend to earn a greater share of profits as they progress through their careers, and that gives that kind of cash flow issue there. Next slide, please. Okay, so I'm just going to talk you through a kind of hypothetical example just to point to show you in practice what this can mean. We have a fictional LLP, which is a professional services firm with 40 members, which draws up his accounts to 30th of April. So let's say profits for the year to 30th of April 23 are 20 million, and for the year to 30th of April 24, they're 24 million. So under the current rules, in the 23-24 tax year, and this example just assumes that all the members are on the current year basis, so we haven't got any opening or closing year issues. So the members' basis periods would be 12 months to 30th of April 23, and they'd be taxed on their share of the 20 million profit. This is just a very high level estimate, but we can assume that tax and NIC on that 20 million of profit would be about £9 million. But what's going to happen is, because we've now also got this to bring in this transition period profit, we have to bring in addition to that 12 months of profit to 30th of April 23, 11/12 of the profits to 30th of April 24. Again, we can take off overlap relief, but that's bringing 23 months of profit into the tax year. Next slide, please. So that's just this slide just puts some figures around that. Again, hypothetical examples, carrying on that example from the previous slide. So there we have, with our 23 months of profits having to be taxed, we've got 42 million of profits. Let's assume overlap relief is £5 million. So that gives us 37 million of taxable profit in 23-24. On that, we can say that in aggregate, there'd be about £16.5 million of income tax and NIC payable. So if we compare that to the amount under the old rules, which would have been 9 million, we've got an increase in tax of 7.5 million. Next slide, please. Okay, so this just carries on the example into the following tax year as well. So it just highlights what's going to happen from 24-25 onwards, where you're going to have these apportionments every single year, effectively, if you've got an accounting date which isn't in line with the tax year. So in that example, carrying on this example, so as well as the 37,000 profits that I mentioned from the previous slide, for 24-25, we have to bring in £2,000, which equates to 1 month of profit from your period ended 30th of April 23, plus 11/12 of the profit from the year ended 30th of April 25. So just to give you some figures around that, we get to that number of £24,900 brought in, which compares to the 24,000 which would have been brought in if the existing rules continued. Next slide, please. Okay, so there is some relief for that acceleration of tax, and that's dealt with through these spreading provisions in relation to this transitional profit. So what spreading does is it brings 20% of the transitional year adjustment profit. And when I say the transitional year profit, that's the profit that arises from that stub period to the end of the tax year in 23-24, less any overlap relief. So 20% is brought in 23-24, and then a further 20% in each of the following 4 tax years. So spreading applies automatically unless it's opted out of. As I said, the purpose of this is to mitigate the acceleration of tax payments. Opting out is an individual election. So each partner in a partnership can choose separately to opt out or otherwise. But we think that many partnerships may prefer their partners to take a common approach, particularly if they operate tax reserves for their partners. The election can be made within 1 year of the filing date for the relevant return. That means there is time to decide whether you want to make that election or not. And the election can apply to any amount, or out of the spreading amount that's still left to be brought into charge. So you can either bring in all of it, or you can bring in a certain amount that you want to accelerate into a given tax year. And the effect of that, if you accelerate in one particular tax year, then the amounts that are spread over the subsequent tax years over the spreading period are adjusted accordingly. So making that election might be attractive if the tax rates were to increase. The good thing about this is, because of the flexibility about only having to make an election 1 year after the filing date, is people will be aware if the the tax position is going to be worse as a result of spreading the tax or not. So it gives some time to actually make a decision on that. Another point to mention is that cessation, so that can happen if the business ceases, or in a partnership example, if a partner leaves the partnership, then that cessation will accelerate all of the remaining spreading into the year of cessation. Next slide, please. Okay, so here is just an individual example. So this one shows where you have no spreading. So let's pretend the individual's profits to 30th of April 23 are 200,000. And then for the 11 months to 31st of March 24, net of any overlap relief, we have to bring in another 150,000. So you've got £200,000 of profit, less overlap relief, 50,000 there. So our taxable profit without spreading would be 350,000. Next slide, please. And then this one shows what happens with the spreading effectively. So we still have our £200,000 profit to 30th of April 23. We have our £200,000 adjustment less overlap of 50,000, which gives a net adjustment of 150,000, but then we only bring in 20% of that. So we only have to bring in the £30,000. So that means that the profit for 23-24 is 230,000. We then have to bring in that 30,000 into each of the next 4 tax years as well. And again, that's unless it's accelerated either because of a cessation of the trade or by electing out of the spreading in any year. Okay, so I've given a broad overview of the basis period transitional rules. There's a couple of other just technical points just to mention as well. So if there is a loss arising due to excess overlap relief in the transition year, then this can be carried back 3 years instead of just 1 year. So that's intended to be a sort of helpful alleviation, particularly for people who may have, for example, reduced their hours or taken parental leave in the year of transition. So actually, their figures in that period are not as healthy as they have been in previous years. Another point to mention there is that transitional period profits are going to be ring-fenced as a separate component in the income tax calculation. It's quite a technical point, but what that does, it prevents it affecting net income, which is used to calculate entitlement to certain allowances and means tested benefits. So particularly helpful for lower income taxpayers. And that point around the allowances, a point to mention there is it doesn't impact personal allowance. However, it doesn't impact on the pension allowance. So the amount that's brought in as the extra profit as a result of that transition doesn't affect pension allowance tapering, which is quite helpful. Also, as a result of how that additional profit is brought in, there's some clarification in the rules to make sure that international partnerships that have tax on overseas profit in the transitional period can benefit from double tax relief. There is some more guidance from HMRC on that expected, because there are some complications that we talk to HMRC around on that, particularly in regards to spreading. And the other thing as well, that tax reducers like for EIS investments can be set against the tax on transitional profits. Next slide, please. Okay, I won't go into this in too much detail, but it's just to highlight the income tax calculation, just to show where these transition profits are brought in. As that illustration shows, at step 2, the net income excludes transitional profits. So these are ignored for the purposes of child benefit, means tested benefits, and pensions allowances. So that's where that is quite helpful. And then the tax is then brought in at step 4 before we get to step 6, which is where we claim things like DTR and tax reducers and such as well. It's quite complicated. However, I think hopefully the software will do these calculations for us. But it's something to be aware of anyway, and just make sure that actually we are able to claim the right reliefs and things. Okay, next slide, please. So moving away from the transitional year, so the rules will take full effect from 24-25, so next tax year. And once we get into that system, then all sole traders and partners of trading partnerships are going to calculate their taxable profits on this tax year basis going forward. So we're never going to have overlap profits and relief again, unless the rules revert back. But as it stands, we assume this, we're never going to have that situation again. A point to bear in mind is that partnership return periods and partner basis periods are different, and they shouldn't be confused. It's a question that comes up quite often as to what will the partnership return report. Now, as it stands, the partnership return will be filed on exactly the same basis as it is now, which is for the accounting period. So the partnership's accounting period ending in the tax year, which does cause a mismatch with what the partners have to file. It's something that we have been talking to HMRC about. They are quite sympathetic about the issue, and a point that actually a lot of businesses probably have raised with us, and we've raised with HMRC, is that it'd be preferable for them for the partnership return to be filed on a tax year basis as well. Now, if they don't change their accounting date, then that will mean the partnership return periods need to apportion profits of different periods. However, that's considered generally easier than pushing it all onto the partners, particularly where software picks up the partner figures from the partnership return effectively. So that's something perhaps watch this space on. Next slide, please. Okay, and just to mention again the requirement for apportionments and estimates. So where you have a non-tax year end, then partnership profit allocations for part of the tax year, they may not be final when partners have to file their returns. We think large partnerships are more likely to be affected due to the complexity of the accounts, the tax computation, and then also how the profit sharing arrangements work. Often having to be decided through committee, significantly after the profits have been determined. So HMRC, were sympathetic to large partnerships having significant admin burdens as a result of these changes, and they did consult on some options for administrative easements. However, after consulting, there were some more radical options that they'd been talking about, like extending the filing deadline or allowing adjustments in later returns, but they've all been ruled out on the grounds they were too difficult to implement, and actually there wasn't a broad consensus amongst people they consulted with about which would be the best option. So the option that they've decided to take forward is to allow returns to be filed with estimated figures and for an amendment to be submitted when the next return becomes due. So probably many of you thinking, what's the difference to now? So, and when we asked that question, HMRC said, well, what you normally have to do is submit an amendment as soon as the final figures are available. So what we're allowing you to do is submit the amendment when the next return becomes due, to which we said, and we think that's what happens in practice, probably 99% of the time anyway. So there's not a lot of easement in this option, but I think it's the best we're going to get to. So partnerships who are sticking with accounting dates late in the tax year will probably have the most difficulty. So we have a lot of businesses with the 31st December year end, and they probably will find it quite difficult. So we'll be relying very much on having to estimate figures in order to be able to comply with this new tax year basis. Okay, so I'm just going to finish with some key points that businesses may need to consider now. So the tax payment profile and cash flow modeling are a very worthwhile exercise to do, particularly for partnerships who reserve for partners tax, which partner tax reserves often provide a very much needed source of working capital. So they may need to be thinking about how they're going to plug that gap under this new basis. They may also need to talk to their bank. They may also be thinking, or should really be thinking about whether to stick with an accounting date which is not aligned with the tax year, or whether to go ahead and change their accounting year end to 31st of March. I've also mentioned changing to 31st December as well, because when we talk to some businesses, particularly international businesses, they've said, well, maybe our current accounting date, there's no real benefit to that anymore, and that might have been 30th of April in the UK, but rather than change to 31st of March, we may prefer to change it to 31st December, which is the accounting date, which is preferable in all of our other jurisdictions. So that's something that they may want to think about as well. But there's a lot for them to think about before they change their accounting year. and a few examples there. So budgeting for a shorter or longer accounting period, assessing partner performance and paying profits for that period, impact on staff contracts, pay, bonuses, holidays, the firm's accounting systems and supplier relationships. So all of those things that are connected with changing accounting date. Generally, the larger the business, the more difficult it is for them to be able to transition to a new accounting day. But we do know that many businesses are very much thinking about that, and some have already decided to make the move. Okay, third point on my list is a partner communication plan. So we've suggested to many businesses that they should perhaps provide some FAQs or briefing packs or seminars to their partners so they understand what the new process is going to be. And we think there's a real benefit in doing this because it preempts a lot of the questions that partners may have and be raising later down the line, particularly when time's quite tight, in order to meet these filing deadlines. And the next point there is to formulate a plan for the compliance for the transitional year, because as for all the reasons I've discussed, there's going to be a lot of extra work in this period, so it's good to get a timetable and a plan ready in advance for that. Again, I mentioned a lot of businesses won't be able to provide final figures to their partners. So I'm talking about partnership businesses here. So they should really agree some process for providing estimates to the partners and thinking about that in advance about how they will do that. And then the last point on my list is particularly for these sort of larger partnerships. So it's considering the impact on international operations. So it's things like double tax relief and such. There's a particular point around spreading. It's quite relevant at the moment. Something we're talking to HMRC about, because it's not 100% clear how businesses will manage their double tax relief claims, because where you have profits in that transitional period which have been spread, you've got a bit of a mismatch there between when those same profits are taxed in the other jurisdiction and when they're taxed in the UK, which probably from a sort of legislative point of view is probably all makes sense about when you can claim double tax relief. However, in practice, we know that businesses will have a lot of difficulty with this. So we're talking to HMRC and we're pushing them to provide some more guidance on that. Okay, so that brings me to the end of my session. So happy to take any questions and provide answers if there are any coming through.
I've got a couple for you, Jitendra.
Sure.
You knew you could rely on this. The spreading election, which takes the transitional list and effectively chops it up into 5 equal bits.
Yeah.
You said you could elect out of that treatment. Does that only work one way, in that you can elect to pay more tax, i.e. pay tax on more than 20%, or does it go the other way? You could elect to pay tax on less than 20% and spread the rest over the remaining 4 years? No,
you can't. So what the way it works is that the spreading is automatic. So it automatically brings 20% in each of the 5 tax years. What the election does, it's an election to accelerate some additional profits into a particular tax year. So let's say you've decided not to make any election in the first year, so you get 20% of your profits tax. But then let's say in the second year you decide actually for some reason you want to bring more of the profit in and pay the tax sooner. Then you can make an election to accelerate. Now you've got 80% of that profit left, so you could bring in the whole 80%, or you could bring in any amount between 20. So you still have to pay the 20, but you can bring any extra amount. So between the 20 and the 80 that's left, so you could choose to say an extra. You could say I want to pay an extra 20%. So by the end of year 2, you've effectively paid 60%, and then you've only got 40% remaining for those 3 subsequent years.
Thank you. And now I'm sure a lot of people listening will have this question. For overlap relief, what do I do if I haven't got the overlap figures? Because they do go back quite a long way. Yeah.
They do. So there is so HMRC have been saying that there is a process that you can ask them if they can provide the figures. So I think we can probably provide some information about that after the webinar about how you go about that. But they have said they will do that and they will help where they can. from what I've heard, and partly through my role with this IoT and discussions we've had, with that hat on, is that effectively they won't recreate any overlap. What they'll do is effectively look in their own records, effectively. So that's based on whether there's any overlaps been reported in historic tax returns. And if they have a figure available on their system, then they'll provide that figure.
Great. Thanks, Jitendra. No other questions? Can we have the next slide, please? Chris, over to you on pension tax changes.
Thank you very much. I'll try and be quick. Right, I'm Chris Holmes. I am with Sadiq, the in-house pensions tax advisory team, as well as being a tax line consultant and champions in lots of other areas. So next slide, please. So first off, there is a link at the top of this page to a BDO article we wrote that summarises a lot of what I'm going to discuss here today. It was specifically written for BDO staff to send to their clients as a starting point to discussions around the pensions changes. So feel free to use it for the same thing. If you can't remember that, we will send a link with the slides and everything. But actually, I googled yesterday BDO pensions changes, and I think it was the third one that came up on the list, so it's fairly easy to find on Google. Anyway, so there's an article that summarizes most of this. Some of these slides you would have seen in my quick 2-minute overview from last year, so from last month. So what I'm doing here is a much more considered discussion. So annual allowances first. The annual allowances have increased, or various limits have increased, adjusted income, etc., and the maximum abatement has increased to £10,000. So basically, everybody should now be able to put in more funds into their pensions each year, provided they've got the cash to do so, and the earnings to frank it. So I think that's all I'm going to say on annual allowances, because that's just really a change in numbers. Next slide, please. All right. Similarly, money purchase annual allowance. I don't know. This is one that often gets overlooked. The money purchase allowance. What this does is this creates a cap on the annual allowance for money for defined contribution schemes, and it applies when you first start drawing a pension, although it is possible to take a lump sum out without triggering this. But effectively, that cap has also increased to £10,000 from 4. Next slide, please. Right, okay then, the big change on lifetime allowances. This was a slide from last time around. Right, under the old rules, whatever your lifetime allowance was, for most people it was 1.07 million. You could take 25% tax-free lump sum, and the rest would be a 75%. You could access the balance of 75% as a drawdown on which you pay PAYE. Anything over and above the lifetime allowance, you could choose how you took it out. You could take it all out, in which case you could take the whole lot out, in which case you would pay a lifetime allowance charge of 55%, or you could decide to leave it in there on if there's a benefit crystallizing event, in which case there'd be a 25% charge. Plus, when you later decide to take it out, it will be subject to PAYE. The rules now are that excess is not subject to. There is no drawdown. There's no 25% charge, and rather than a 55% charge when you take it out, it's simply an income tax charge at marginal rates, which for most people will be 45%. So it is a slight reduction. So because the numbers we're talking about, we'd expect it to be 45%. So in effect, it's still fairly similar, but you'll only get charged tax as and when you take the funds out. The next slide is just to highlight a few points. So next slide, please. Right, okay. These are key points that for you to talk about funds. So income tax will apply if you extract any cash from the pension fund. So accepting if you got the tax-free lump sum. Right. Critically, and this is where the big change is, if you leave your monies in the fund, there will be no lifetime allowance charge triggered by other events like reaching 75, transferring to a QROP, or death before 75. Those ones that trigger when you're not actually accessing and charge the fund itself shouldn't apply. They will not happen. So that's it. Now, if you have a lifetime, if you have a historic lifetime allowance protection, that will mean that it still exists, because you're for the purpose of how much tax-free lump sum can you take out. So if you have it protected at, let's say, 1.6 million, then you can take out 1.6 million or a quarter of 1.6 million as a tax-free lump sum. So, and then, but they've also brought in this new rule that says if you have got a protection, they're the fixed and the enhanced protections. In order to retain them, you couldn't make any further contribution to the fund after the particular date. This is now saying you can now start putting money back into into a pension. You can start making pension contributions, although I would recommend people don't start doing that until the actual legislation's in place. Right, next slide, please. Right. What we the one that, because of this, because we now no longer have this tax charge simply by leaving the money in the fund, what we're expecting is that more and more people will consider leaving the pensions or the pensions being part of their succession planning, part of their inheritance tax planning. Now, the pensions had always been an important part of succession planning, but we think it will become even more so now. But there are a couple of things you need to be aware of. Yeah, the Perry case, or often known as the Staveley case, because Staveley was the lady who died, and Parry was the beneficiary who was who was a member of the case. In that case, the lady had deliberately taken the choice not to draw down on her pension, and that was deemed to be a gift at that point in time, and therefore, benefit passed, and it wasn't on death and all this sort of thing. So it was deemed to fall that the pension no longer fell within the IHT relief, the IHT exemption. So the pension became subject to IHT. So we have to be very careful that it's all right if you just don't get around to cashing in your pension, and some of it gets left for your beneficiaries. But if you deliberately choose not to draw it so it can be inherited, we've got to be careful of this case. The other thing to be aware of is that if you die after your 75th birthday and you leave a pension to your beneficiaries, they are going to be subject to income tax on it if they take a lump sum. They can also take it as a pension and do other things with it, but if they choose to take a lump sum, which many do, they're going to be hit with a 45% charge anyway. So actually 40% IHT, 45% income tax if they're high rate taxpayers. It just needs to be borne in mind. Next slide, please. Right, this is an important point. Now, we don't want to be scaremongering here. There's going to be enough people in the industry going to be doing it just to generate fees. But if we're advising on a client on pensions, we have to be conscious of all of the facts and let them know all the facts. Labour have stated that they will reverse the abolition if they win the next election. So what if they do? So there is a 18-month, say, opportunity. I'm not sure if that's the right word. I shouldn't be encouraging people to do this, but there is an 18-month window in which people might choose to take activities to crystallize their funds, such that what would formerly be known as a benefit crystallizing event happens now, whilst there's no LTA charge accruing. So that might be, in one case we're looking at a whole family. What the eldest is going to be 75 in July, so he's happy because he's sorted. Other options are, I should say, we had a chat with an IFA, about a specialist IFA on this one. So these are investment solutions, not tax solutions. So we need to be careful what we're saying. But you could, for example, you could choose to crystallize your pension fund into a drawdown mode and not necessarily draw down on it, or just draw down slowly on it, or something like that. So you can, once you've crystallized it, you take your 25% lump sum and crystallize the rest as a as just a set for drawdown, then that would be a crystallizing event. You could transfer the entire fund to QOps. If you did that now, or if you did that before April, you would have had a benefit. You would have had a BCE if you transferred the whole lot. You can transfer the you could have transferred the excess over the LTA, but that's another story. Here you can transfer the entire fund to QOps. Then that should be outside the scope of anything. And the other way is to establish what's known as a scheme pays annuity. This is rather than purchasing an annuity, you enter into a contract with a pension fund to pay you an annuity, but it actually is paid out of the fund. So the fund will then invest and keep it going. And if you die and there's still some of the fund left, it just gets passed on. And that again will trigger will be a crystallizing event. So what we've got to be careful of, though, is that we have no idea how it will be implemented, if it will be implemented. It will we be wasting our clients' time, but when it is implemented, might there be anti-forestalling measures? I guess most people I spoke to think that would be retrospective legislation, but the very fact they've announced they're going to do this now, could that be seen? Could they try and say that that's not? I mean, they're not in government, so maybe it is. But anyway, that's an interesting. That's something we need. That it's for your clients to consider, and if necessary, with the help of a specialist IFA. Next slide. I think that's me done. Any questions?
Thank you very much, Chris. There are no questions on your session at the moment. There is one on the partnership session, which we will answer after Sadiq's session.
Okay. I will pass on to Sadiq.
Next slide, please.
Okay. Thank you very much, Malcolm. Thanks, Chris. And good afternoon, everyone. Okay, so my presentation is all about how the government's current stance and policies are on corporation tax and what their future stance is going to be. So if we go into the next slide, we will see that the government has increased the headline corporation tax rate from 19% to 25%. We should all know about this. That's for all large companies, basically companies with augmented profits above 250,000. The 19% will remain for all small companies, which aren't closed investment holding companies, and the marginal rate will apply to profits in between 250k to 50k. So it's also important to note that these rates are only for the next 2 years, so there is actually no corporation tax roadmap. So let's see what the government's thinking here. I'm going to paraphrase some of Jeremy Hunt's comments from his budget. He said that even after the corporation tax rise this April, we will still have the lowest headline corporation tax rate in the G7. Only 10% of companies will pay the 25% rate. Our corporation tax regime did not incentivize investment as effectively as countries with higher headline rates. The result is less capital investment and lower productivity than countries like France and Germany. So in conclusion, the government's stance here is that they're going to increase rates for the next 2 years, but they're going to introduce a whole host of reliefs, which my presentation will talk about now. So if we go on to the next slide, we'll see what these reliefs are. And the biggest one of them is their capital allowances regime that is now in force from 1st April. What happened is the super deduction, you can say bye-bye to that. That's gone. And it's been replaced by something called full expensing. So full expensing's come in, and it's coming in for the next 3 tax years till April 2026. So what is full expensing? So the 100% is 100% first year allowance, which will be available for expenditure on new and unused plant and machinery that would have ordinarily qualified for the 18% main rate pool. So it would have usually got an 18% written down allowance. Now it's going to get 100% first year full expensing. And it has to be new and it has to be unused plant and machinery. Now, what about for special rate pool? Well, that's going to be a temporary first year allowance of 50%. So 50% first year allowance is available for expenditure on new and unused special rate plant and machinery. So these are things like integral features in a building and long life assets that would have normally qualified for the 6% special rate pool written down allowance. So one thing to remember is as the 100% and 50% deductions are first year allowances, The general exclusions for first year allowances will also apply. So expenditures on carbon emitting cars or plant and machinery required for leasing will be excluded from these full expensing first year allowances. Now, the spring budget also announced that the annual investment allowance will permanently be 1 million. So it won't switch back to 200,000. It will permanently be 1 million. What does that mean? That means that companies now need to consider the allocation of the annual investment allowance in conjunction with any expenditure not eligible for the 100% full expensing first year allowance and the 50% first year allowance. So you'll have to pick which assets you use the 1 million annual investment allowance, and it's better to pick the assets which don't qualify for the full expensing. And in conclusion, in the Chancellor's words, these are very welcome developments, and it underlines the importance of business investment to the economy. So they're trying to get more companies and businesses to invest to push up productivity. If you go into the next slide, we'll talk about investment zones. So it was announced in the spring budget that the government will establish 12 investment zones across the UK. And these investment zones come with a host of tax reliefs. The main ones being full relief from SDLT for commercial land and buildings, full business rates relief, 100% first year enhanced capital allowances for plant and machinery, an accelerated enhanced structure and buildings allowance at a rate of 10% per annum, and secondary class 1 NICS relief for certain employers with certain employees. So a whole host of tax reliefs, and they're the locations which it's going to be in. One thing to remember is these reliefs will be time limited, and they haven't mentioned the exact end date for these reliefs. So that's investment zones. If you go into the next slide, this talks about R&D changes. Now, there's been reforms of R&D tax relief for many years recently. And the budget also included R&D relief changes, which have already taken effect. The budget changes are actually in the last column of this table, which I'll just quickly talk through now, because there's been a whole host of changes. So in the autumn statement, changes to the R&D reliefs were announced. It was good news for large companies. As you can see from the table, the RDEC was increased to 20% from 13%. But as bad news for SMEs. Profitable ones reduced their qualifying expenditure credit to 86% from 130%. And for loss-making companies, the repayable credit was reduced to 10% from 14.5%. So it was very bad news for small companies. Now, the Chancellor listened to the outcry, and he announced at the spring budget that there would be a small change for loss-making businesses. So loss-making businesses that had qualifying R&D expenditures of more than 40% of their total annual costs will be able to claim a repayable credit of 14.5% of their costs, which was the position before the autumn statement. This means that the effective rate of subsidy relief will become 27%, so slightly less. So while SMEs will still lose some funding support from April 2023, the impact will be less than previously anticipated. So that's the R&D relief changes. If you go into the next slide, this is my last slide, and it basically talks about the government's introducing corporation tax reliefs for a range of industries. So it's really good news for UK creative sector. So there's been increases in tax relief for film, TV and video games businesses. They're going to get increased expenditure credits. I think they go up to 34% and 39% for video games. And there's been an addition to an extension to the existing post-COVID higher rates for tax relief for theatres, orchestras and museums. So the temporary higher headline rates for relief for theatres and for museums will continue. It will remain at 45% for the next 2 years, and orchestra tax relief will remain at 50% for the next 2 tax years. And finally, tonnage tax. A new tonnage tax election window for 18 months will open on 1st June 2023. And tonnage tax is also being opened to UK ship management companies for the first time. This will make the UK a more attractive location to operate and manage ships. Okay, so that's the end of my presentation. I've spoke to you about the main message here is that the corporation tax rate has increased 25%, but there's been a whole host of reliefs introduced, and those reliefs have already been introduced from 1st April 2023, and this presentation went through all those. And that's all I wanted to cover.
Lovely. Thank you, Sadiq. There's one question on your session.
Sure.
So Sadiq or Chris or Jeff, full expensing, this one is on.
Yep.
The questioner said, isn't this only relevant to companies spending more than £1 million on plant and machinery per year? Don't know if anybody's got any view on that.
Well, companies will have an annual investment allowance of 1 million. So I think that's where the question's coming from, isn't it?
You might have mixed the two together.
Yeah, exactly.
I wasn't aware there was a minimum spend of £1 million to get 100%. Any views on that, anyone?
I haven't read anything about a minimum threshold required to get the 100% first year allowance and the 50% first year allowance.
No, I haven't seen it.
Yeah, but I think the question's around, well, we're going to get an annual investment allowance of 1 million anyway. So to get benefit of the 100% first year allowance, well, we're going to have to spend more than 1 million anyway, which is kind of right if you think about it mathematically. Yeah,
mathematically, yeah. Let's do Jitendra, are you still with us? We'll go back to the partnership query. This is a client who in the mid-1990s accepted HMRC's they were estimated assessments of 30k per annum for 3 years. It doesn't look as if these were ever amended to actual figures. The question is, can I use these estimated figures to calculate overlap relief? And in my limited partnership knowledge, I would assume that they would only be relevant if it was in the sort of startup years of this business, or if they changed their accounting date. But Jitendra, over to you.
Yeah, thanks, Malcolm. Yeah, it's a good question. I think you're right. I think we might possibly need more of the facts, but however, I think if what we're saying is there were assessments made based on estimated numbers, if as a result of those assessments, then individuals paid tax on overlap profit effectively, so they did pay double tax on the same profit, then if that is the case, then I would say the answer is yes. Then it should be possible to take those into account, regardless of whether they were estimates or actual numbers, because if the facts are that those people did pay tax twice on the same profit, then you should be able to get relief for that. But yeah, as I mentioned, I think as you alluded to as well, it probably needs a bit more of an investigation as to exactly what the history is in order to conclude on that point.
I think we've exhausted the questions. Can we have the next slide, please? So the next webinar is the 10th of May. It's a morning session at 10 a.m. So please make a note in your diaries. And also just a further reminder that the annual conference will soon be upon us. It's a full day event in person at 55 Baker Street, strikes, etc. permitting. And it's on the 22nd of June. So please do make a note in your diary for that. Invitations will be coming out probably towards the beginning of May for the annual conference, and expect an invitation for the 10th of May webinar in the next week. Without further ado, all I've got to say is thank you very much for coming. Hope you enjoyed it. Hope you found it interesting, and we'll see you next time. Thank you very much indeed.